85,000 people woke up to find their savings frozen. Their therapy sessions were being sold to Facebook for ad targeting, and the browser extension they trusted was allegedly stealing money every time they shopped. In 18 months, 5 sponsors promoted by millions of creators turned into lawsuits, congressional hearings, and broken trust. Creators with millions of subscribers suddenly faced a harsh reality. The sponsors they trusted had been deceiving everyone. From browser extensions stealing commissions to crypto exchanges hiding massive fraud, 5 major sponsorship scandals shattered the foundation of online trust. If this breakdown helps you understand the hidden dangers in creator sponsorships, hit subscribe so you don't miss our next investigation. For over a decade, YouTube sponsorships felt different from traditional advertising. When your favorite creator recommended a product, it felt personal. They used the products themselves, shared genuine experiences, and built relationships with audiences that brands could only dream of. If MrBeast promoted honey, it must save you money. If Graham Stephan endorsed FTX, it must be safe for crypto investing. If your mental health YouTuber recommended BetterHelp, it must provide quality therapy. This trust built a multi-billion-dollar industry where influencer recommendations became more valuable than Super Bowl commercials. But this trust was built on an assumption that would prove catastrophic, that creators actually knew what they were promoting. Honey seemed like the perfect sponsor for creators who cared about their audience. A free browser extension that finds coupon codes and saves money while shopping. PayPal bought it for $4 billion in 2020, giving it corporate credibility. YouTubers from tech reviewers to lifestyle creators promoted Honey with genuine enthusiasm. The pitch was simple. Install Honey, save money, everyone wins. But in December 2024, YouTuber Megalag published a 23-minute investigation that changed everything. Honey wasn't just finding coupons, it was stealing commissions from the very creators who promoted it. Here's how the scheme worked. When you clicked through a creator's affiliate link to buy something, Honey would pop up at checkout offering to find coupon codes. The moment you clicked Honey's button, it replaced the creator's tracking cookie with its own. This made Honey the last click in affiliate marketing, meaning Honey got the commission instead of the creator who actually drove the sale. Even worse, Megalag discovered Honey often didn't provide the best available coupons, prioritizing codes from business partners over better deals found elsewhere. But creators felt betrayed. They'd been promoting something that actively undermined their income. About 3 million users uninstalled Honey from Chrome in the aftermath. Content creators filed class action lawsuits seeking damages for commission theft. The response was swift. Creators who once eagerly promoted Honey suddenly felt like unwitting accomplices in a scheme that hurt both them and their audiences. But if a simple coupon app could hide this much deception, what about the companies handling real money? By 2019, Raid Shadow Legends had achieved something remarkable: ubiquity. The mobile RPG seemed to sponsor every YouTuber on the platform. Gaming channels, cooking shows, comedy creators. Everyone was reading identical scripts about Raid's AAA quality graphics and over 500 champions. The repetitiveness bred mockery. Raid became a meme, shorthand for YouTube's most notorious sponsor. But in February 2020, Raid made a claim that stunned the community. When asked about sponsorships on Twitter, Raid's official account responded, "Hi there, we do not sponsor. We cooperate only with those YouTubers who play our game and want to be our influencers. We do not pay money for it." The response was immediate and devastating. Content creators began posting screenshots of the actual sponsorship offers they'd received from Raid's marketing team. Explicit emails offering payment for integrating Raid ads into their videos. As one analysis noted, the denial conflicts directly with numerous appropriately disclosed sponsored content already public. Gaming news outlets called it the stupidest lie imaginable. Raid officials soon clarified their earlier tweets, effectively retracting the denial. Why would a company lie about something so easily verifiable? The likely motive was to portray Raid's popularity as organic, to suggest YouTubers promoted it out of genuine love, not because they were paid. This spectacular miscalculation revealed how sponsors could manipulate the entire narrative around authenticity. But lying about sponsorships was nothing compared to what came next. Sam Bankman-Fried appeared on magazine covers as crypto's wunderkind. His exchange, FTX, positioned itself as the safe option in the volatile crypto world. Finance YouTubers with millions of subscribers staked their reputations on SBF's credibility. Graham Stephan, Meet Kevin, Andre Geek, top finance creators promoted FTX as a regulated, trustworthy platform. Some reportedly earned tens of thousands per month from FTX sponsorships. Then November 2022 arrived. A leaked report exposed that Alameda Research, SBF's hedge fund, had a shaky foundation. A huge portion of its assets were tied up in FTX's own token rather than stable assets. This revelation triggered a frenzy of customer withdrawals that exposed a staggering $8 billion hole in FTX's accounts. Within days, FTX was insolvent. Court-appointed investigator John Ray III described it as really old-fashioned embezzlement. This is just taking money from customers and using it for your own purposes. The company had virtually no corporate controls. Billions in customer funds were used to buy luxury real estate, venture investments, and even political influence. Approximately $8 to $10 billion of customers' money vanished into a black hole of bad bets and misappropriated spending. This segment is brought to you by Transparency. If this investigation into sponsorship scandals helps you make better decisions, tap subscribe so you don't miss our next deep dive. The human impact was devastating. Viewers flooded comment sections with stories of lost savings and anger at the personalities who had steered them to FTX. YouTuber Graham Stephan posted a contrite video saying, "I was wrong and I'm sorry," and that he trusted FTX, but in the end their parent company was not forthcoming with all of the risks. In March 2023, a class action lawsuit was filed against multiple YouTube influencers who promoted FTX. The suit claims the creators did not disclose the nature and scope of their sponsorships and compensation, nor conduct adequate, if any, due diligence. Seeking up to $1 billion in damages, it argues that FTX's yield-bearing crypto accounts were unregistered securities. SBF's journey from magazine covers to prison was swift. On March 28, 2024, he was sentenced to 25 years in prison for fraud and money laundering. For the influencer community, FTX represented a worst-case scenario: investment advice from trusted creators leading to devastating financial losses. Losing crypto investments was painful. But what if even the safe option wasn't safe either? While FTX collapsed in the high-risk crypto world, another cautionary tale was unfolding in traditional banking. Yotta launched in 2020 with a novel premise: turn saving money into a game. Users who deposited savings earned tickets for weekly jackpot draws with prizes up to $10 million instead of a high interest rate. The app branded itself as a no-lose lottery, claiming that even if you didn't win a prize, your savings were safe and FDIC insured. Finance YouTubers like Graham Stephan promoted it as a trendy, risk-free way to grow your money. For a while, the strategy worked. Yotta attracted over 100,000 users, many drawn by social media promos. But critics worried that Yotta's gamified model blurred the line between healthy saving and dangerous gambling. The app offered only around 0.2% APY, extremely low by market standards, meaning users' main incentive was the chance at jackpots. By 2024, critics argued Yotta was extremely destructive to the financial well-being of their users by reducing personal finance to a dopamine-driven game. The no-lose promise came under scrutiny. While Yotta partnered with chartered banks for FDIC coverage, as a fintech middleman, it wasn't a bank itself. Fine print acknowledged that funds are only FDIC insured once deposited in the partner bank. This distinction seemed academic, until calamity hit. In May 2024, theoretical risks became painfully real. Synapse, the back-end banking-as-a-service provider that Yotta relied on to hold and move customer funds, collapsed financially. The startup filed Chapter 11 bankruptcy, and a bitter dispute erupted between Synapse and one of its underlying banks over a multi-million-dollar shortfall. Caught in this crossfire were Yotta and its customers. Roughly 85,000 people, with a combined $112 million saved in Yotta, suddenly found their accounts frozen. People who had trusted the no-lose app lost access to their own savings, some having to borrow money for groceries or postpone surgeries and weddings because their funds were stuck. The stories are heartbreaking. Yotta CEO Adam Molis lamented, noting he never imagined something like this could happen, with FDIC-insured partners. It turned out Synapse had not actually placed all Yotta users' funds at Evolve Bank. It had transferred a significant portion to other institutions within its network just before going under. The no-risk assurances had a blind spot, the risk that a fintech's intermediary could fail, even if the bank itself hadn't. Throughout 2024 and into 2025, under oversight of bankruptcy courts and trustees, frozen funds began to be released and refunded to Yotta users. But confidence was badly shaken. Industry observers pointed out that Yotta's young customers had been drawn in by game-like features and trust in influencer endorsements, only to be confronted with very adult financial nightmares. Each scandal hit closer to basic human needs. First shopping deals, then investments, now emergency savings. But the deepest betrayal was still to come, and it involved the most vulnerable people of all. In 2018, mental health advocacy was having a moment on YouTube. Creators openly discussed depression, anxiety, and therapy with unprecedented honesty. When they seamlessly segued into BetterHelp sponsorships, it felt like a natural extension of their advocacy. BetterHelp was promoted as an affordable, accessible way to get professional counselling. From Shane Dawson to Philip DeFranco, creators shared heartfelt encouragements like, "If you're struggling, you're not alone. Consider seeking help." Crucially, these links were referral links. Creators earned a commission for each person who signed up through them. But user complaints began surfacing. Many didn't realise the pricing. While advertised as $35 a week, users were often charged hundreds up front because the plan billed monthly or quarterly. Numerous complaints described subpar quality of therapy, counsellors who were unresponsive, unhelpful, or even unprofessional. Critics discovered problematic terms of service. BetterHelp's terms stated that the company does not control the quality of the counselling and cannot guarantee that any given counsellor is qualified or matched appropriately. It bluntly noted that their service is not a complete substitute for a face-to-face session by a licensed professional. This stunned people. Many YouTubers had confidently said BetterHelp would connect you with a licensed therapist within 24 hours. In October 2018, a massive YouTube drama erupted, often called the BetterHelp scandal. PewDiePie, YouTube's biggest star at the time, released a video calling out fellow YouTubers for pushing what he considered problematic. Under pressure, many YouTubers quickly suspended or ended their partnerships with BetterHelp. But the story didn't end in 2018. In March 2023 came a new bombshell. The US Federal Trade Commission announced a proposed order against BetterHelp, accusing it of deceiving customers by sharing their sensitive personal data with third parties for advertising purposes after explicitly promising not to. This data included users' email addresses, IP addresses, and even the questionnaire answers they filled out about their health status and therapy needs. According to the FTC, from 2017 to 2020, BetterHelp repeatedly assured users that such information would be kept private or used only for limited purposes. In reality, BetterHelp was funneling this data to companies like Facebook, Snapchat, Pinterest, and others to target ads. As the FTC noted, even an email address alone, when shared in this context, constitutes a disclosure of the consumer's health information, since it signals that person sought counselling. Imagine seeking help for depression, filling out a private questionnaire about your struggles, then seeing BetterHelp ads follow you across social media because your deepest vulnerabilities had been sold for ad targeting. To settle the case, BetterHelp agreed to pay $7.8 million to reimburse affected customers and to institute strong limitations on data sharing. The order bans BetterHelp from sharing user health data for ads ever again and requires affirmative consent for any future data disclosures. It was the first time the FTC returned funds to consumers over the disclosure of health data. The ultimate betrayal was complete. People seeking help for mental health had their private struggles commodified and sold. Even mental health, the most personal area, had been turned into a marketing opportunity. By late 2024, a pattern had emerged that couldn't be ignored. Comment sections that once thanked creators for recommendations now overflowed with anger and betrayal. "I trusted you" became the most common phrase under sponsorship videos. Creators posted apology videos en masse, expressing shock that they'd been unknowingly promoting harmful services. Unsubscribe waves hit channels that had been built on years of trust. The realization was devastating. Audiences weren't customers being served, they were products being sold. Each scandal revealed how the failure of an unseen intermediary can cascade down to end users, highlighting why transparency in sponsorships is paramount. This wasn't about a few bad sponsors making isolated mistakes. This was about a system that incentivized deception at every level. Sponsors prioritized growth metrics over user welfare. Creators prioritized sponsorship revenue over due diligence. And audiences paid the price, sometimes literally, with frozen savings, stolen commissions, privacy violations, and investment losses. The trust that had built the entire creator economy was shattered. From the wreckage of these scandals, new rules are emerging. The FTC is tightening disclosure requirements, making it clear that transparency isn't optional. Creators are learning that due diligence isn't just recommended, it's essential. As industry observers noted, the scandals serve as a wake-up call that influencers must be treated as genuine partners, not exploitable pawns. Audiences are more skeptical, but also more educated. They're asking tougher questions. How much is the creator being paid? What are the real terms of service? What happens if this goes wrong? The creator economy isn't disappearing, but it's evolving. Sunlight is the best disinfectant. And in the wake of these scandals, the influencer world is letting in much-needed sunlight. Trust is the real currency of the creator economy. Once broken, it's nearly impossible to rebuild. But from Honey's commission theft to BetterHelp's data betrayal, each scandal has taught us the same lesson. A sponsorship built on deception can generate short-term hype, but it risks brand devastation, legal consequences, and broken trust that no amount of promo codes can repair. The most trusted voices online learned they could become unwitting accomplices in massive consumer harm. Their audiences learned that even their favorite creators can't guarantee the safety of what they promote. And the industry learned that growth without ethics isn't sustainable growth at all. The trust economy didn't collapse. It got rebuilt on a foundation of transparency, accountability, and genuine care for the people who make it all possible, the audiences who choose to trust. Well, I hope you enjoyed that video. Please do consider subscribing to the channel if you found value in this. Oh, and YouTube thinks you will like this video. Do watch it before you leave.